Hi, everyone. I'm assuming the sound is working now. Give me just one. Okay, perfect. Sounds working. I didn't add myself to the stream apparently. So thank you all for the notifications. So let me just start over. It's a really fascinating time. And obviously, the main topic is the daily chart. We have a strong breakout yesterday. And the question today was, were the bears going to get strong follow through? And obviously, we're at important support, the March 2nd high. Yesterday was a big enough bar that there were probably sellers above and it was going to lead to a second leg down. I did not think we would get a follow through bar. I thought we would get something disappointing, kind of like this right here. It's hard to see, but this is the March 8th close. We got a big bear bar that was a surprise and bad follow through, but it still led to a second leg down. This is good for the bears. If you think about it, any of the bulls that bought yesterday's close, how are they feeling about today? They bought what they thought was maybe exhaustion, two legs down, and now they got follow through. That could lead to the potential of a sell off. The bears still need to close below March 22nd. However, the reality is this is strong enough, we're probably going to get a small second leg down. And this is the problem with breakouts in a trading range. If you think about it, let's go to a weekly chart and visualize this rally from March 13th to up here. So if we look at a weekly chart, we can see that's a strong breakout and we have a second leg up. Right now, it's probably going to form a higher low and we're going to rally to the February 2nd high. But you always have to wonder, similar to what happened today, we have a strong rally and we got an endless pullback. Now, you could argue, obviously, context is different. This was a rally that broke above a major lower high in a bear trend. So it just basically broke out This formed a trading range. It broke to the upside and failed and reversed. But the point I'm getting at is when you get consecutive trend bars, you always have to wonder this could sell off quickly. It probably won't. It'll probably get a second leg down and continue the disappointment. But 4,000 is not all that far away. 4,000 is right here. And we could easily get down there. Midpoint of this rally is around 4,019. That is obviously another target for the bears as well. But I suspect tomorrow, it'll be interesting to even see what happens on the Globex market. But I suspect tomorrow is going to find some profit taking. We're at an obvious level of support and we will probably bounce. I don't think we're going to form, do I think we're going to sell off all the way down here? Probably not, at least initially. But I am definitely interested to see, can the bears get a strong close and follow through tomorrow? In other words, I do believe the first reversal up will fail. Yesterday, we gapped down and had a bear trend from the open. And the surprise yesterday was bar 44 and 45. That led to a measuring gap and a measured move down. So you could say that, let me get rid of some of these lines. You could say we got a measured move from here to the start of the measuring gap, which was, I'm just curious. We obviously got there. The next target, you could argue, would be the highs over here. But anyways, let's go back to today. We had a bear trend line break, and a second leg down. First bar of the day, I'm going to make the bars a little bit bigger so they're easier to see. And feel free to ask questions. I will take a look at them at the end of the review. First bar of the day, bar 1 is a bear bar. Slight gap down, closed in the middle of yesterday's bar 79. Probably buyers below, scaling in lower. It's basically consecutive sell climaxes, even though we rallied into the close of the prior day. So you have to wonder if we're going to get 50% chance we get initial trend resumption down and then reverse. More importantly, 75% chance we're going to get a trading range lasting at least 2 hours. Bar 2, reversal bar, buyers below 1, probably sellers above 1 and sellers above 2. But it's basically a tight trading range. It's a triangle. We're in the middle of the highs and the lows. So you're basically in breakout mode. Bar 3, a second leg down from bar 1. So 2 legs down, probably buyers below 2, just like there were buyers below 1. And you have a bear bar. The bears need consecutive trend bars, though. Otherwise, probably 3 is probably a buy the close bar more than a sell the close bar. And you can see on 3, everybody bought the close and we rallied. 4, second entry buy, but a big tail. We did not trigger the high on 2. That lowers the probability of traders buying above 4. Some bulls front ran the close of 2. They bought the close right as 2 closed, and we sold off on 3. A lot of those bulls will buy more below the 2 low, betting that we will retrace back up to here. 6, sold off, broke below 3. So it's basically a wedge, 1, 3, 6. You can argue a gap down and a sell off to 1, pull back, sell off to 3, pull back, sell off to 6. So it's a wedge bottom, reasonable buy above 6, but it's a low probability buy. If you're buying above 6, you know you have pretty much a 40% chance of the day of 6 being the low of the day, which means it's probably not the low of the day. So the reality is there's probably sellers above 6, but it's a second entry buy. We've had only one bear bar closing on its low with a decent sized body, so not really all that ideal of a buy. Bar 7 is an inside bar. Probably buyers below 7, just like there were sellers above 6. This is a tight trading range, and you know that you're going to get a breakout up or down one way or the other. Outside down on 8, we triggered the buy above 6 and 7 and sold off, and we triggered the sell below 7. So more trading range price action. And then 9, a big bear bar closing on its low, probably going to get below the 79 low, and we have a pullback. So we rallied, we're pulling back, and we're getting a bear breakout below the lows of the past 7 bars. So you have to wonder about a measured move down if we're going to do that. And then 9, it's probably a sell to close bar. It's okay, but you have to wonder there's probably buyers not far below 79. And then 10, a bigger bear bar. It's always in short, probably sell to close. If you sell the close and 11, the next bar is a bull bar closing on its high, it will make sense to get out if above the bull bar. And then 11, it's a bear bar, but a small body. Still probably sell the close and going a little bit lower, but we had a pretty climactic day yesterday. Tight trading range right here. So possible final flag, which means the 79 low is going to be a magnet. Bulls will buy the 79 low and look to scale in lower. Bar 12, 2 legs down. Reasonable to buy above the 12 high and put a stop below 12, or maybe put a stop measured move down of the bar. It's a low probability buy. You're betting on a final sell climax and a rally up to the open of the day. Probably better to wait for 2 or 3 consecutive trend bars or a micro double bottom. For the bears, reasonable to exit above 12 because the stop is somewhere up here. And the odds are, while we may go a little bit lower, we're probably not going all that lower. And then 13, bulls giving up, bears giving up. Why would the bears give up above 12? 12 is a small bar after a strong sell off. The reason they would give up is what I mentioned. If you're a bear, do you really want to sell above 12 and put a stop above 10 or 9? Probably not. And the reason is bad risk reward. In a strong trend, you're willing to trade high probability for bad risk reward. You're gaining high probability, but you're paying for it with terrible risk reward. When a trend gets weaker and weaker, or when the trend lasts for a long time, there's a greater risk of reversals. So everybody wants to sell a pullback. Nobody wants to sell down here. This is the profit taking zone. So if you think about it, one of the things that's important to do is if you are short from anywhere, let's say you sold below 9, this bar right here. Had you sold below 9 and you see 12, would you be willing to sell above 12? If you would not be willing to sell above 12, which is this bar right here, and you were still short, you have to exit the trade. What's really important to remember is other people's money does not exist. What exists is your current account balance at that exact second. It doesn't matter where you entered the trade. You could have sold the open of the day and had a windfall of profit all the way down here. That doesn't matter. What matters is here's the current price. Are you willing to sell there or not? It's the same thing with buying above 12. If you bought 12 and the market's all the way up here, you cannot say that this is someone else's money from 12 to 33. It's in your account. You have to figure out a way to take it. So where I'm getting at is when people think the market's in a trading range, you have to tighten your stop. 13, bears giving up, probably going to fall, probably going to rally above the 79 low. Open of the day is another logical magnet, which is right here. I'm going to make it green. I typically make the open of the day green. 13, big enough surprise, probably at least a small second leg up. Therefore, there's probably buyers on the close of the next bar scaling in lower. Bull bar on 14. But again, strong enough rally, probably buyers below, and at least a second leg up to the open of the day. 15, a bear bar. Possibly sellers above 15, but with all the trading range price action we had on the open, and with what I said, the odds are today's going to be a trading range day which means we're probably going to go sideways for at least 2 hours into the day. 16, bull bar at the moving average, probably going at least a little bit higher. It's possible we rally and get a bear bar closing on its low and get a second leg down from 9 and 10. But 4 strong bull bars out of the past 5 bars probably limits the downside. And then 17, rallied, but bad looking low 2, probably buyers below. It's possible we get some form of a bull breakout of a bear flag. We rallied, we have a low 1 and a low 2. Instead of getting the low 2 and selling off, it's possible we do the opposite and break out to the upside, which takes you all the way up to here. And then 18, an inside bar. Actually, it triggered above 17, so it's not an inside bar, but it's another bull bar closing above its midpoint. Where are the bears and why are they not making money? If you sold anywhere in here, you got trapped above 12, and even the bears that sold the 12 high or higher have not been able to make money. The last time the bears made money was selling above 11, scaling in, which is not all that ideal. 19, strong bull close. Looks like we're breaking out above a bear flag, so probably buy the close 19, stop below 18 or 15. 19 is a possible exhaustion bar. It's an upside breakout, but this whole rally from 12 to 19 is probably leg 1. And if it's a leg 1, that means you expect a second leg down. Another way to look at it is 46 has a tail. So here's a low, here's another low, and here's a low down here. So this is a bear channel. The important thing to think about with bear channels is it doesn't really matter how you draw it. We sold off here and we broke steeper to the downside. Other traders will look at it and say, this is a trading range. We tried to break out of the range, which we did on 10. We got follow through, but we immediately reversed back up. Since we failed to break out below the range, you have to wonder if we're going to try and break out to the top of the range. And then 20, follow through. The follow through is as strong as the breakout bar, so that is good for the bulls, which means we're probably going to get some form of a measured move up. Measured move takes you to 41.10. So still buy the close, stop below 18 or 19. 21, a bull bar, smaller bar, but only one bear bar since 12, so probably buyers below scaling in lower. 22, another bull bar, still buy the close, but it's fairly tight channel and it's a micro channel since 15, and we've only had one bear bar, so it's becoming a little bit climactic, but still probably buyers below and scaling in lower. And then you can see on 23, we have a bigger body and it's more climactic. We have a tail, another tail, small bar, small body, another small body on 22. 23 started to rally and become more parabolic. So if you think about it, we have a breakout on 13, and then we started to pull back on 15, and we're channeling up on 16 and 17 and 18. What happened on the close of 19? 19 broke out of a small channel from 15 to 18. So this breakout reset the count. In other words, it started the market cycle over. Now, 21, 22 is the start of another channel. It's a new channel. 23 is an upside breakout. It's trying to break out and reset the count. So it's becoming parabolic. You can argue it's a parabolic wedge with 14, one of these highs up here, and then 23. But the reality is this channel up is so tight that there's probably buyers below scaling and lower. So a lot of traders, when they see 23 and it rally, they will start selling as the bar is going up, betting that they can buy a pullback. And that's what happened on 24. The market sold off and traders started buying the close of 20, the low of 21, and scaling in lower. 24 is a bear bar. It's a bad high 1. But when you have a channel that is this tight, even though it's a bad high 1 above 24, and there might be sellers above 24, those sellers are scalping. So some of those sellers, they'll sell the high of 24 and scale in, maybe sell the high of 23. Other bears, they just sell the high of 23. And their only goal is a small profit. And generally, a small profit might be half the size of an average bar. So if an average bar is, let's say, 3 points, in this case, 23 is 4 points, they might be selling the high of this bar or this high for a quick 2 point scalp. But it's not really ideal. Again, the channel's tight. Better to only look to buy in this scenario. But when you look to the left, you're at the top of reasonable targets. Top of bar 1, top of bar 81. So probably a trading range in here. The other thing to think about is we have a lower high with 81 and we sold off to 12. This is probably a final flag, which means we're probably going to get above the 81 high. So if you're selling, it's not really ideal because we're probably going above the 81 high, which is this line right here. 25, a bear bar. As you can see, bear sold the 24 high. 25 is a pullback, and we got a second leg down on 26. 26 is testing back to the open of the day and the moving average and also the midpoint of this bar. Some traders, they sold the high of 19 betting on exhaustion and they scaled in higher and they got trapped on this bar right here. So what are they going to do? They're going to use any pullback to try and exit break even. So I know it's hard to see, but it's worth pointing out. If I sold this close and I sold more, so I sold right here on this close. I sell more on this bar right here, bar 20. Break even is right at 4,100. And you can see we went below 4,100 and reversed up, allowing those scale in bears out of the trade. The reality is most traders, had they sold here, which was not ideal, if they did and they got followed through on the next bar, most traders should exit. It gets really complicated scaling in, trying to avoid a loss, especially against a strong breakout. 27, a bull bar, second entry buy, but a tight trading range really since bar 21, forcing traders to buy high in that tight trading range. We have a strong enough rally up to 23 that there's probably buyers below scaling and lower. So the reality is you can probably buy above 27, especially if you're willing to use a wide stop. 28, follow through, and 29 is pulling back. For the bears, it's a second entry short. You can call it a triangle, 3 pushes up. It really doesn't matter. It's still probably minor. The bears have yet to get a close at the moving average since bar 19. It's possible 28 is a pullback from the 27 rally, so there might be more buyers right here than sellers. And you can see 30 rallied, tried to break to the upside and failed. 31 here is an important bar. Why did that happen? If you're a bear and you want to sell below a bar like 29, and then you see 30, your stop entry to sell below 29 did not get filled. Are you going to sell below 30 now that it's a bull bar? Probably not, which means traders started buying the close. Look at the low of 31 compared to the close of 30. As soon as 30 closed, traders hit buy the market, and the market rallied pretty strongly. 31's closing above a lot of bars to the left. It went one tick above bar 81. It's a little bit of surprise on 31, but somewhat of a climactic rally in a likely trading range. We could easily pull back to the midpoint of this trading range right here. So as far as buying the close of 30 or 31, it's not really that ideal of a trade, but we still are probably going to go at least a little bit higher. We still have the magnet from the 19 close to the 20 open, which takes you up to 41.10. And then we got follow through on 32, but forcing you to buy at the high of bar 81. So not really ideal. 33, a doji. It's a bear bar, consecutive buy climaxes. The bulls probably are better off waiting for an upside breakout above 81 with follow through before they look to buy. And that's why 33, it's a high one buy, but consecutive buy climaxes at the top of a trading range, not really that ideal. Probably buyers below 33. But what are those buyers going to do when they see 34? They're trapped. So if you're a bull and you bought the 33 low and you see 34, are you saying, gee, that's exactly what I wanted to see? I'm going to buy the close of 30. I bought the low of 33. I scaled in lower at the close of 44. And, this is exactly what I wanted. No, you're thinking, dang, maybe I just bought the high of the day. This might be a double top with 81 and 33. And here I am, I just bought the low of 33. So a lot of bulls will be quick to exit at the low of 33 on 34. So the one thing in this situation what I'm always thinking about is limit order traders. Can limit order traders make money? So if you're a bear and you sold the high of 12 and you scaled in, this is kind of the opposite of 12 and 13. 12 is a decent signal bar, and 13 and 33 is not a decent signal bar for the bears. And if you're a bear and you sold the high of 12, what are you going to do on 13? You're thinking, that's not good. If I sold the high of 12 and I see 13, you know, you just have to exit the trade, and you've got to exit the trade really quickly, because if limit order traders start to exit, we could race up quickly. 33 and 34, kind of the same thing. So a lot of traders will wait to see, can the bulls that buy the 33 low scale in and avoid a loss? So let's think about that for a second. Why does Al in the video course say that gaps are important? Gaps are a sign of strength. Gaps cause traders to get trapped. If you're a limit order bull and you buy the 33 low and you scale in more on 34, what are you feeling on this bar right here? Well, it went lower and it's starting to pull back. A lot of traders are deciding, if I bought this low and I bought more here, and maybe I bought more at the low of the bar, it doesn't matter. The question is, how desperate are the bears? How desperate are the bulls to exit the trade? If they're very desperate, we may go a little bit up and then immediately reverse down. So to me, with 34 and 35 breakout and follow through, you always have to wonder, there's probably going to be a second leg down, which means probably not by the close here. And then 36, a bear bar, probably buyers below 36, but now we have 4 consecutive bear bars. And just like we had a bear flag, we had a bull flag here, we had a bear flag from bar 12 to 18. Bear flags, in other words, are pullbacks in bear trends. Here we got an upside breakout. Right here, what do we have? We have a bull flag, we have a rally, and a pullback. When you get a pullback late in a rally, in other words, we rallied for several bars, we have a pullback that is just below important resistance above, that will increase the chances of a downside breakout. But you always have to be aware of that, especially in a trading range. Now, why? Why does that happen? It happens because of risk. If I'm a bull and I bought, let's keep it really simple. I'm going to buy the close of this bar, 32. Where's my stop go? Probably below 30. But what we know is every time you get a new breakout, every new rally in a trend is slightly lower probability than the prior rally. So when you look at a bar like 13 and then you see 14 breakout follow through, there's probably a 90% chance you're going to get at least a small second leg up. Now, is it 90? Is it 80? Who knows? But we know it's reasonable to buy betting on a second leg. When you see a breakout like 19 and 20, it's reasonable to buy betting on at least a small second leg. Then you see 30, 31, 32. The problem is, how many reasonable breakouts have you had since the low of this move? You've had 1, 2, and then at least 3, and that's not including maybe one of these. So you've at least had, at a minimum, 3, which also means, how many reversal attempts have you had? You've had 1, 2, maybe 3, or you can just say this whole thing from 24 to 26 is 2, and then maybe 3. But either way, you know that this is probably lower probability than this breakout. And because of that, you know you need at least a 60% chance if you're buying the close of 2, stop below 30. You need at least a 60% chance before you can buy if you're buying for a risk reward of 1, which is bad risk reward. What that means is the trader taking the opposite. There's 2 traders here. And this is kind of oversimplifying it, but I think it's really important to think this way. There's 2 traders. One is going to sell the close of this bar, stop up here, target down here. The other is going to buy the close of this bar right here, stop down here, target up here. One of those traders is going to win. Right now, the probabilities might be, slightly better for the bulls, but not 60%, which is not what that means is more and more traders will start to take profits and they'll start tightening their stop. Another way to look at it is if you're buying up here and you put your stop at the swing low, that is really big risk reward. And the odds are we're probably not going up to 41.20 before we pull back. So traders will start tightening their stop. They tighten it below 30, they tighten it below this bull bar, and some tighten it below this bar. And what that does, I did not mean to do that. So what that does is it causes traders to start bailing out of the trade. And when that happens in a trading range, it can happen really quickly. So with 34, strong enough bear bar, there's no way I'm going to buy this high 1, which means there's probably sellers on any pullback of 34. Let me just check one thing really quick. And then looks like the bear's giving up further, 37, another bear breakout, possibly 2 legs down, 35 and then 37, but very tight channel. And this is a breakout on a higher time frame, which means probably where I'm getting at is 34 is consecutive, it's 3 or 4 or 5 bear bars on a 1-minute chart. Here we have how many bear bars? 1, 2, 3, 4. We have 5 bear bars. Well, what's 5 times 5? 25. So on a 25-minute chart, I'm kind of making this up, but on a 25-minute chart, let's just pretend it's one really big bear bar. What does that mean? That means that the first up's going to fail. So let's just play around with time frames for a minute. I think this is also important to think about. Here's a 15-minute chart. So this right here is 12:30. That's 12:30. It's probably going to lead to a higher low, but it's a big enough bar that it's probably going to have a second leg down. Remember 12:30. Find 12:30 on this chart. Okay, here's 12:30. Big enough sell off. Probably the first up is going to fail and lead to at least a little bit lower prices. So you always have to remember this rally from 12 to 18 is one breakout bar on a higher time frame. This sell off from 33 to 36 is one breakout on a higher time frame. If that doesn't make sense, make a comment, because fractal, that's why you hear people say markets are fractal. It's a really important topic to understand. This sell off from 8 to 13 is one bar on a higher time frame. So it's really, really important to practice looking at other time frames. You should be able to analyze a 5-minute chart or a 30-minute chart. And the reality is you should be able to, if you look at the encyclopedia, Al's encyclopedia, and you're bothered that there's not a price axis or a time axis on the charts, that's a problem. That means you're uncomfortable with fractal markets. You have to be comfortable with every time frame. That doesn't mean you should trade every time frame. What I mean is you have to be comfortable. You have to be comfortable looking at a 145-minute chart, strong enough breakout, second leg, or a 73-minute chart, strong sell-off, second leg, or a 600-minute chart, strong rally, forming a channel. We're pulling back after a rally, maybe a wedge top. We're starting to pull back, and then we got a strong breakout, probably a second leg down, testing this high. So the point is, it doesn't matter what time frame you look at. So where are we? Here's 38. 38 is a doji. It's a strong enough sell-off, probably sellers above scaling in higher. But one thing you always have to wonder is you never know how many bulls are waiting on the sidelines to buy. And that could be true here. The reality is at this moment, we have probably seen the low of the day. But the one thing you have to think about is we have a very tight channel. And when you get a tight channel, you always have to be worried that this is leg one and leg two could be much, much lower than leg one. So if we get, here's leg one, maybe we get a shallow pullback, we could pull it back to here and then get all the way down to there. So that's why it's really important to wait for a trend line break and then a test of the lows before looking to buy. 39 consecutive bull bars, but that is a lot of damage done by the bears, which means there's probably sellers above. One thing I like to do, by the way, is look at other time frames. So maybe the SDS. The SDS is the inverse of the SPY, and it can be really helpful to look for a bias. So that can sometimes help you out. Let's see, trying to kind of match them up. So here is 1240. And you can see if we go right here, here is 1240. So we rallied. So here's the open. We broke to the upside and we had a very strong sell off and a new low. And then we have a give up bar, second leg up. This channel up is so tight, probably buyers below and at least going a little bit higher. Probably sellers above and at least going a little bit lower. 40, low one short, but there might, 50-50 chance there might be buyers below 40 and the bulls get at least a small second leg up. But that second leg up is probably for a scalp. So the bulls buy the 40 low, they buy more below 39 or the 38 low, and they're looking for a scalp. 42, a doji, and then 43, a second leg up. So we have two legs up, 39, pull back on 42, rally on 43, and it's a double top, 39, 43. While this could easily test back to the 36 low or the 34 low, we're holding below the moving average, and the bears are still probably going to get a second leg down. It's possible 42 is that second leg, but when you look at the sell-off from 34 to 37, typically most breakouts have a second leg. I mean, it's actually really, really high probability that almost every breakout has a form of a second leg, even if you can't see it. 60 right here. We broke out. We had a 1 bar pullback and a 1 bar second leg. 63 broke out, pullback on 64, second leg down. I mean, they're really all over the place. We have a breakout on 68, pullback on 69, second leg up. So it's hard to see, even this bar right here, 77, pullback on 78, big second leg up. Bear bar on 44. Is it sell to close? It might be, but probably buyers below. I think most traders better off waiting. And then 45, a wedge bottom with 38, 42, 45. 3 pushes down, but bulls not making money, and they haven't made money since somewhere over here. So the bears are in control, and it's possible 45 is a trap. For me, if I was trading always in, I would probably exit shorts above 45. Aggressive bulls can buy, but if you're buying above 45, small signal bar, it's a low probability trade. And it's basically a higher low major trend reversal. We have a bear trend yesterday, trend line breakups 33, pullback to 45. 45 is a tight enough channel though that it may need a trend line break and a retest. It's possible the trend line break happened on 43. But yeah, I don't know. And then 47, 46, what happened? You had bulls buy the 43 low, which is where my mouse is, right here. They scaled in lower. They bought the 43 low, bought more lower on 44. And what did 45 do? 45 retested the low of 43, and there were sellers, and it led to a second leg down. And then 46, 47, it's basically a breakout with follow through. So the bears, looks like their bears are gaining control. And because of that, that means that this might be a sell to close and some form of a measured move down. So in other words, it's a bear breakout below a bull flag. We have a pullback, should be a bull flag. We're getting a bear breakout. The first target, whenever you get a bear breakout below a bull flag, which is a fancy word for saying you're getting a bear breakout below a trading range or a channel. This sideways trading is a second leg down. We had a sell off 34, 35, 36, 37. That's basically a one bar breakout. We're pulling back 39, 43. We should start forming a channel. And when you start to form a channel, that means that the markets should evolve into a trading range at some point. We have a breakout, sideways trading, so starting a channel, tried to break above the channel, and we reversed into a trading range that shifted into a bear trend. Here, 25% chance in general, you get a bear breakout below a bear channel. So in this case, that's what's going on right here. 48, reversal attempt, but 46, 47, to me, there's bulls that are trapped. Bulls bought the 45 low. They bought more lower on 47. They're deciding what to do here. Do they get out on 48 or do they hold, betting that the market gets back to this area? You could argue it was reasonable to buy above 45. Bulls buy above 45, this bar right here, and they buy more lower. And maybe they buy more above a bar like 48, which is what happened right here. 48 is the midpoint of those entries. So you buy here, you buy more above a bull bar, and here is break even within reason. So it's pretty much going to be 40.96. I'm going to change the scaling real quick so it's easier for everyone to see. So it's right around there. And you can see everybody sold at close. So we have open gaps. We have a gap, 35 low, 39 high. We have gaps, 42 low, 49 high, somewhere in this area. And they're negative gaps. If you're in the trading room, that's brought up pretty frequently during just the normal session, as far as negative gaps are gaps on a line chart. So when you see negative gaps, these tails, in other words, the close of any of these bars, the close of 44 and the close of 48 creates a gap. So the way I look at it is, to me, this is the gap. Just pick a place. That whole thing might be the gap. And if that's the gap, then you have bulls that are trapped. Bulls bought any of these lows, scaled in. They're having a difficult time making money. If they're having a difficult time making money, that means that stop entry traders are not making money, which increases the chances of lower prices. 49, 50, and 51 consecutive bear bars, still probably going a little bit lower. To me, it looks like a leg in a trading range, but it's also a small pullback trend, and small pullback trends are deceiving, and they can keep going down a long, long ways. What are the chances that we stay above the high of the day? I still think we'll probably stay above the high of the day. Obviously, they are lower than over here. Open gaps, so you always have to wonder about the potential for some form of a measuring gap. And then obviously what happened on 52 is everybody giving up. Everybody's starting to agree that we're successfully breaking out to the downside. This might be its sell vacuum, test of the 12 high. But to me, 52 has a lot of energy behind it, and it's a lot of momentum. And if you look at the breakout, I believe the breakout was It's right here. So it's bear bar, bigger body, even bigger body. That is a sign of something strong. So it's important to pay attention to the momentum of the breakout. If you go to Al's, I believe it's the I believe it's the trading range book where it's signs of strength in a breakout, or if you want to cheat and just go to the breakout videos in the video course, I believe it's the fundamentals. I believe it's just the section that just says breakouts and the fundamentals. One of those videos has a PowerPoint. It has a PDF attached to it of all the bullet points of the signs of strength of a breakout. But one of the signs of strength is small pullbacks. So the market's selling off, and during the bar, the pullbacks are not big. So, in other words, when this breakout forms, you do not want to see it pull back 50%. It's okay if it pulls back a little bit and sells off. What that means is traders are selling every pullback aggressively. And it's more difficult if you're a limit order bull to exit a trade without a loss. So when the pullbacks are small, it's very hard. It's just like 45. That's a good example. This bar sold off pretty aggressively, and it was almost impossible to buy and scale in lower and avoid a loss. So it traps a lot of traders. When you get breakouts like this, 24, it sells off and then pulls back rather deep. It allows all those traders out. Another example is this big bar 63, deep pullback. All the bulls that bought the 62 low over here and that got trapped on 63 were able to avoid a loss. So 52, 53, breakout, follow through, probably going lower, always in short at the lows of the day. So probably buyers down here, but this channel is very tight. Another thing to point out is, and I want to show this, I got to show this on a higher time frame, but I do want to point it out. I'm trying to make this rally from 12 to 33 look like, just a regular breakout. That's why I'm kind of like playing around with time frames. I'm not recommending you look at a bunch of time frames during the day. I'm just trying to paint context to this. So here's a good example. So we have a rally. Focus on this chart right here. We have a rally from this bear from here to here. In other words, draw a box around it if it'll let me. It's really annoying. There we go. It actually might make it harder to see. But this area right here, we have a breakout, and it's reasonable if you're buying in here. Some traders will buy and put a stop down here. But the problem with that is it's okay to do that if it's a trend because you're betting that the first reversal down is going to fail and lead to a second leg. The problem is if it's a trading range, we could sell off all the way to the lows. And the other problem is there's probably buyers below here. So even if we get to this low, which is the 12 low, there's probably buyers below. But the issue with that is sometimes you get this, where you just keep selling off much, much lower. So if you buy anywhere in the bottom third and buy more at the 12 low, what do? A lot of those traders panicked and they got out on 60. I'll talk about that in a minute though. So bear breakout follow through, still probably going at least a little bit lower, but it's still sell to close. It's late in a sell-off, so a lot of traders will be fairly quick to exit if this starts to reverse up or if you get a bull bar closing on its high, but probably okay to sell to close. 54 broke below 12 and it found profit taking, some bulls buying aggressively. 55, a bear bar. It's basically a micro wedge, sold off on 53, sold off on 54, sold off on 55. Channel down is tight, but you're at support. And remember what I've mentioned. If you're selling down here, where's your stop? It's somewhere up here. You always have to think about, what am I currently risking to make? It doesn't matter where you entered. It does, but it doesn't at the same time. So whenever if you go to probabilities in the trader's equation videos, and I'm trying to reference videos because I really want to tie back to, studying and what to study eval. Go back to probabilities in the trader's equation videos, and there is a section over there's risking one or two ticks to make, risking 10 points to make one or two ticks. You don't want to be in a situation where you're risking 10 points just to make a little bit lower, just for the market to go a little bit lower. So, in other words, you don't want to be the trader up here that bought up here and had to stop all the way down here and hold all through this. So, you've got to have a way to get out quickly. 56, bear bar closing on its low. So, we should have bounced, but instead, we're continuing lower. And you have to respect how strong the bears are. We have obvious measuring. We have a target below the high of 33, low of 48. 57, a possible reversal, but tight channel. So there might be more sellers above 57 than buyers. For me, I would exit shorts above 57. There's too much risk that we could break out to the upside and go back up to here. It does happen. 50, and then we went down on 58. And you can see it triggered the buy and sold off. Probably buyers below 58 and 57. So some bulls buy above 57. They buy more below 57. 59 is a bull bar closing on its high. Decent bull bar. Probably buyers above for at least a scalp. But that's probably all they're going to get. So if you're buying, for me, I wouldn't. I think it's pretty dangerous to buy there. I think a lot of bulls are going to use 59, the current bar, to try and exit above somewhere up here. So some bulls, they bought here, they bought more lower. They're going to use the first reversal to probably take profits. 60, a little bit of a surprise, consecutive bull bars, probably buyers below 60 for at least a small second leg up and probably going to get to the moving average. But instead, we got a strong bear bar. Still probably buyers below 60 and 61, scaling in lower. But what happened on 62? It's a big bear bar, trapping traders that bought the 60 low and the 61 low. So in other words, it's similar context to this. It's the same kind of logic. We rallied to support and we got a big sell-off, and it trapped anybody that bought a pullback. Over here, bulls bought the low, they scaled in, and they got trapped on this bar. And then 63 followed through, still probably buyers below scaling and lower, but tight channel. And with 3 consecutive bear bars, we could go a lot lower before we bounce. So sell the close 63, sell the close 62. What about sell the close of 64? You can, but it's a doji. And whenever you get a doji in a sell the close market, and this is pretty extreme, we had a sell off to 48, pullback, strong sell off to 57, pullback, strong sell off to 65. So this is not really all that ideal. And then 66, bull bar. For me, I would exit shorts above this bar for sure. Would I buy above it? I would not. Tight channel. The reality is the bulls that bought above 59, plenty of them will look to buy more above a bull bar like 66. But this bar didn't trigger, and they'll do the same thing on this bar right here. So why did 67 immediately reverse up? You had bulls buying, and they bought more below 66, betting that the market would at least go sideways. You had bears who were disappointed with 66. They're willing to sell closes, but then when they see 66, they're going to exit on a new low. So it's a sell-off, pull back on 66, second leg down on 67. And then a lot of traders giving up above 68, reasonable for bears to exit, okay for aggressive bulls to buy for a scalp. You can see that's basically the midpoint of this bar, 59 and 68. It rallied. The midpoint is this exact line. A little bit of a surprise on 69, probably buyers below and at least a small second leg up. But very strong sell off. And the reality is we are going to touch the moving average, but you always have to wonder if it can go a little bit lower. And then another low one short on 69. So we had a low one, 60, and the low one was a big bull bar. We have a low one, 69, and it's a big bull bar. Still probably buyers below 69 scaling and lower. And then we got 70 and we reversed up on 72. And a lot of those traders that bought and scaled in started to scalp out. You can see some bulls, they bought the close of 69. They bought more on a pullback. And what did they do on 72? As 73 went above 72, they started selling. And bears did the same thing. And you can see we rallied into the close. Forward stop entries. I thought the first okay stop entry was selling below 9, but it's a possible third leg down and it's selling low in a trading range. Had I sold below 9 and 10 was a bull bar closing on its high, I might exit. And then 12, I thought that 12 is one of those kind of interesting buys, and it's an okay swing buy, but it's low probability buy. So if you buy it, you put a stop below 12, or you buy it, maybe you put a stop, a measure move down on the bar down here, and you buy more lower. The third option is you buy above 12, stop below 12, but you buy a half size position and you get stopped out below 12. And then if you get a second entry on a bar or two later, you buy a full size position. So if you normally trade 2 contracts, you buy one above 12 and you get stopped out below 12. And then you get a second entry, you buy 2 contracts above 12, above that bar. And probably okay to buy above 18, betting on a bull breakout of a bull flag. And hard to do much of anything in here. You know, it's okay to sell below 51, betting on a bear breakout below this channel, but pretty aggressive. So not really all that many easy stop entry trades. No real decent low one shorts to sell here. I thought buying above 27, it's okay, but it's not ideal, forcing you to buy just under important resistance, bar 81. Selling below 60, 61, yeah, I think that's tough too. It always looks easy at the end of the day, but you look at this consecutive sell climaxes. We haven't touched the moving average since 43, so this is almost 20 bars. We had a strong rally, strong sell off, so not really all that ideal. For limit orders, all of this was limit order trading. Bulls buying below bars, selling above bars. They got trapped on the way down. I thought the easiest limit order trade in this area was buying the 14 low after 13 and 14, betting on a second leg up, and probably okay to sell. Probably okay to sell the 38 high. And that's probably it for obvious limit orders. There were lots of limit order trades, traders selling at the moving average, selling above bull bars. But I think this is really hard to be selling above these bars, when you start getting bull bars closing above their midpoints. Buy the close, sell the close, probably sell the close on 9 and 10. Probably buy the close on 13, 14, buy the close 19 and 20. Sell the close 34. 35, 36, probably okay. Sell the close 37, probably okay, but we may pull back first. And then probably sell the close of 52, 53, betting on a second leg down, and you could sell the close of 63, 64. But really, I think selling the close of 63, 62 and 63 or 64 is really hard to do after you see 59 and 60. So let me take a look at some questions. Someone asked about my morning, what is my trading routine? And for me, I try to make a lot of charts over days. I guess that's one form of studying I've tried to kind of pick up on. And as far as, morning routines go, I mean, the first thing I really do is write the blog. And for me, I like writing it because it forces me to have to think and, think about the market for 45 minutes to an hour before the day starts and look at the prior day, look at the day session. And, as far as for a routine, I think it's important for one, it's important to be able to set time aside in trade and not have that many distractions. And the other thing I would say is it's important to think through a trading style. How are you going to trade and what are you going to do? And for me, most traders should try and trade always in. So if the channel's tight, only look to sell. If it's a tight bear channel, only look to sell. If it's a tight bull channel, only look to buy. But, as far as that's pretty much my routine. It's not anything I would say out of the ordinary. Still reading through questions. Someone says, how would you manage a buy above 59 and a sell the close on 63? So, how would you manage a buy on 59 and then a sell the close on 63? Yeah, so 59, I thought 59 is an okay buy, but look at the context. You're buying in a very tight channel. The odds are the first reversal up is probably going to fail. So, it's not a great buy, but it's an okay buy. And if you're buying above 59, stop below 59. I think that's reasonable. For me, you have to think about it like this. If I'm buying above 59 and I see 60, good entry bar, I know two things are likely. I know it's probably a trading range. And because of the risk, whenever you are I want to pull up this day, someone asked this question about on the trading course on one of the blog posts, and I answered it today, but they asked about sparse 18 and 17. I'm going to find it. It's right around here. I think it was on the 20th. Here it is. So traders asked about selling below this bar right here, which is bar 17. It is the 9:55 Central Time. This computer's in Eastern Time. This is my trading computer. But anyways, bar 7, it's possible wedge top, and they asked if you sell below 17 right here. I'm gonna make an arrow just so it's easy to see. If you sell below 17 right there, why not buy back your short above this bar on the next bar? So in other words, why not buy back your short right there? And the problem with that, what I said was whenever you get a wedge in what looks like a trading range, it often tries to shake you out. So you get a wedge, reasonable stop entry, and then you get a good looking signal bar like this high one where this blue arrow is. And it's pretty much a trap. It's forcing you to buy at the high of a trading range. If you look at today, we had a 59 is a decent bull bar, and it's a wedge, but it's a parabolic wedge, and the context is different. And where I'm getting at is we have a low one short here in what could be a bear trend. Whenever you have strong signal bars in the direction of the trend and a clearer trend, it's generally reasonable to exit those trades. And going back to this example here, what I mentioned was if this bull bar right here, where the arrow is, if this was far above the moving average in a clear trending market, kind of like this, like right here, here's a good example. We're in a trend from the open. We've broken above the moving average, and we have a bear bar right here, and then we have a bull bar 2 bars later. It's reasonable to get out of the trade because we're in a trend. We're in a trend, and it can go a lot further. Here, you can argue it's trend, but we're holding below the moving average, and it's probably going to fail. And it's also following a big gap down. So I don't know if that answers your question, but we have a strong sell off, and this is strong enough that it's probably going to have its own second leg down. And when you look at 60 and 61, how are you feeling if you bought above 59 and then you see 61? How are you feeling? You're saying, that's not good. We rallied, we got a good bull bar on 60, and then 61 is a big bear bar. Maybe I should exit my longs. And that's what a lot of traders did. Someone says I sold the 23 close. They sold 23, and is that a reasonable short? Yeah, I mean, I get the logic. They probably it's rallying and you're getting a climactic bar that's making the rally more climactic. And it's what I talked about on this bar that bulls would start selling. But it's still pretty aggressive. You're selling after 1, 2, 3, 4, 5, 6, 7 consecutive bull bars. And there's probably buyers below. So for me, I'd probably be more interested in buying below than selling. Okay, question. Chase asked advice on time frame / market for someone that can only trade a couple hours at night. Yeah, there's two things. I wish I would have thought about this more down the road, but for me, what I would have focused a lot on was, and by the way, this is CRM, Salesforce, and we had a strong sell off on the monthly chart, and we're getting a rally. Whenever you see this rally, it's probably going to get a second leg up. But the reality is, we're probably going to get a second leg down from the sell off. So to me, I think I think the high is in for Salesforce for a long time. But, anyways, what I would do is start looking at Forex markets. I think Forex markets are a wonderful trading vehicle. And they're great because you can trade any time frame with risking pennies or dollars or $10 or $100. So you can risk as large or small as you want. But for someone that can only trade a few hours in the day, a few hours at night, you got really two options. If you can only trade at night, which I'm in Central Time, right now, let's just pretend I'm in Eastern Time because this computer is showing, well, actually, this computer isn't showing anything. So I'm in Central Time, and because there's no time clock at the bottom of the screen. So for me, if I'm trading a 5-minute chart at Emini overnight, it can be a little challenging, but it's doable. So for me, if it's, let's say, here, well, this is in the morning. So let's go to the evening hours. And here's the evening hours, 1600, broke out to the upside, follow through. And that's the close of yesterday. And here is the opening session in the evening. So you have a sell-off from 1855 Eastern Time to 1910, but the range it's about 6 points, so it's not bad. My only problem with the Globex market is I would probably trade a higher time frame, maybe like a 10-minute chart. And the reason is these bars are pretty small, and I would not want a lot of 1-point bars. I would try and make the bars, I would trade at least a 10-minute chart. And you get 3 consecutive bear bars, it's probably reasonable to sell for a second leg down. You could also say that the rally from here to here is probably going to get a second leg up. Wait for a second leg down. You can buy here for a scalp. But my problem is if you've only got, as Chase said, they've only got a couple hours at night to trade. My problem is, do you really want to sit here for 4 or 5 hours in a range that's 5 points? It's okay if you can sell and scale in and scalp, but it's really not that easy. It looks easy after the fact, but what do you do right here? Let's say you buy this low, then you get this bar. Do you exit or do you scale in lower? Well, if you exit, then this happens. So the range is just the problem to me. It's not so much the price action is different as the range gets really small. So Chase, what I would focus on is, for one, if there's no way to trade the US session, I would look at other markets, like Forex markets. Those are great markets. And, you can just, pick anything. So let's go to the euro dollar. Here is, we had a strong sell off and we're going sideways. Here is, let me try and make this chart. There's the time frame. And you can see here's 2:30 in the morning, 3 in the morning, 3:30 in the morning. I don't know if you're a morning person or an evening person. I think there's better volume and movement in the morning. So if I had to pick the evening, if I couldn't trade the US session, I could only trade the evening or the morning. I would trade really early in the morning. But you can buy any of these bars. Buy the close of this bar at 2:30 in the morning, 3 o'clock in the morning, stop down here. Or if you can only trade for a few hours, but maybe you can trade during the daytime. Take a look at 60-minute charts. Here is 3:30 in the morning. You can look at this rally at 5:30 in the morning and say, that's a tight channel. I'm going to buy below here for a second leg up. Or as this bar is selling off, buy for a second leg. Consecutive bear bars at 11 o'clock. What do you think is going to happen? It's probably going to have a second leg down. So there's all sorts of ways. I don't want to go too long in that, but I would trade smaller time frames, or excuse me, I would trade probably Forex markets. Here's a 60-minute chart. Let's go to, here's the Great British Pound, dollar yen. We have two legs up, tight bear channel, probably sellers above, and then we get a bear bar and a big bear bar. 8 o'clock, it's probably reasonable to sell the close, stop up here or here for a second leg down. And we formed a higher low, but we started to pull back in this tight channel, traders exit. And this is a bull breakout of a bear flag. We have a big sell off, we pulled back, and we get a big bull bar and a follow through bar. And you look and you say, yeah, probably shouldn't happen. I'm going to buy the close, maybe stop up here and hold for a few hours. So just because you can only trade a few hours in the day doesn't mean you can't trade hourly charts of higher time frames. Remember, when your goal is to get really good at trading, and the rest will follow. Was the expanding triangle another reason to sell? Somebody asked. I'm not sure which expanding triangle you're talking about. So you can argue expanding triangle from here to, something like that. And, I agree with that. You can argue it's a failed breakout of a trading range. We broke to the upside on 33 and sold off. So elaborate for me. Whenever you ask if something, try to give a example, a bar number, or try to make it Central Time, Eastern Time, Pacific Time. Try to reference a bar, because it's what you're saying makes sense. But if I'm reading what you're saying, it can be easy to misinterpret. I might be thinking about an expanding triangle right here, 38 through 45 and 38 through 43. How important is the location of price in relation to the 20-period EMA to me? The 20-period moving average is just, a lot of people use the 20-period moving average. There's nothing special to it. I like the 20-period moving average because it's a reasonable number of bars. 20 is always a good number. If the market's been sideways for 20 bars, it's probably in a trading range. If the pullbacks lasted more than 20 bars, it might be an endless pullback. There's all sorts of examples of 20 bars. And for the market to stay below the moving average for 20 bars is impressive. The moving average is great as a visual tool for a gap down. We're staying below the moving average, so we have a gap, and we're below the moving average for 20 bars. It's probably a bear trend. First bar above the moving average, and a lot of bars probably going to get sold. We keep trying to touch the moving average, but we haven't touched it, probably going lower. So yeah, for me, I pay attention to the context mostly, but the moving average kind of helps remind me that, hey, we're below the moving average quite a bit. We're probably going to touch it soon. Okay, question. How do you read the current bounce? Expect second bear leg down or strong enough to be always in long? Again, try and give a time frame, a market, or reference because I don't know if you're talking about the daily chart or the 5 minute chart, or it's easy to misinterpret the question. How many trades do you take on an average day? Probably about 10. Maybe it really varies, sometimes more, sometimes less. And it just really varies on how I'm feeling. But I generally like to take a fair amount of trades, but I also like to get in and get out. So for me, I'm less resistant to sell and hold and get out above a bar, and I'm much more likely to sell, take a few points, sell again, take a few points, sell again, take a few points. But other times I'll also go to like a 2 minute chart. So when I see the market selling off, sometimes I'll go to, and again, I'm not recommending to do this, but sometimes I will just go to like a 2 minute chart, sell this close. And if I took profits during this bar, sell this close again. Doji, maybe sell the close, but scalp out, betting on a pullback and then consecutive bull bars. I definitely don't want to be short. Maybe buy the close for a scalp. Several bull bars up, probably buy the close, big bull bar, buy the close, and you know, bear bar, follow through bar. But the bulls, and this is an example of using the moving average. So I bought, I think, below 59 and 63, 64 was disappointing. And for me, it wasn't enough to make me get out of the trade, but I was paying attention to this bar. If this bar were to close down here, I'd have probably gotten out. After seeing today and yesterday, would you conclude that the trading range that started the beginning of April is still in effect or ended? So they're talking about the daily chart. Well, so yeah, what they're asking is after today and yesterday, is this trading range still in effect or are we going to get a measured move down? So trading range, the fun thing about trading ranges is trading ranges love to form trading ranges within larger trading ranges. So what that means is this whole thing's a trading range, but we have a tight trading range right here. So we might break out of this trading range and go for some kind of measured move down to here, but we could find support here and reverse back up. So to me, I think strong enough breakout follow through for at least a small second leg. But I don't know. I think, tomorrow will be interesting to see. I do think that we might pull back a little bit first. So I'm really interested to see how tomorrow is. Is tomorrow a strong bull bar closing on its high, or is it a weak bull bar? Or will tomorrow be another big bear bar? So we could sell off pretty quick to 4,000, but we don't know yet. Do you suggest using a fixed contract size or changing your size based on support and resistance or context of the day? I think most traders should just trade a fixed size. It's easier. If you have a way to figure out what size you should trade and you can do it quickly without any thought, that's one thing. But if you're spending, you should not be thinking about should I trade one contract or two contracts and spending energy deciding that, because the reality is there's lots of decisions to make and you're going to be better off if you can just trade a small position and not worry about it. So I would just trade one size. As a big question, as a beginner, how do I learn at an exponential rate the price action and candle chart patterns? You have to study an exponential amount. There's no shortcuts. And the reality is you have to learn, and you also have to trade. You have to get, there's psychology to it. And the psychology is, to me, is not necessarily reading books. I'm not really, I guess that's never kind of been my thing for reading psychology books over trading. But you do have to learn about yourself and you have to learn, your strengths and your weaknesses. So for me, you got to spend a lot of time studying. And what helped me, I probably spent 5 or 6 years at least studying Al in the trading room. And that was watching basically every trading day for 5 or 6 years almost and asking questions in Al's trading room every day. And you can get the same benefit by going to the recording. So just because Al's not in the trading room now as much doesn't mean you can't get the recordings. I got a ton of benefit out of watching Al in the trading room, but then pulling up the replay, in other words, the recordings of the videos, and really studying, putting pen to paper. If Al said bulls get out here, why did he say that? If Al said bears get out, why did he say that? And the other thing I would try and figure out is always in trading. But the reality is you really have to study. If you plan on watching the video course once and thinking you're going to have it all figured out, you're in for a rude awakening. But if you're willing to study continuously, you'll eventually figure it out. The secret with trading is I don't think you have to be the smartest person in the world to figure out trading, especially with the information like Al's. I think the real secret is you have to be persistent and willing to study. There's so many people that, it's sad, but it's true. People think that they're not capable of figuring out, even though they have Al's information in front of them. And the reason they're not capable of figuring it out is because they've given themselves a timeline where if they fail, they will stop the timeline. There's always the joke. There's that meme on the internet of the guy they're digging in a cave for diamonds, and it's a picture of a guy above and a picture of a guy below, and the guy above is digging, and he quits digging right before, a couple of feet before he reaches diamonds, and he stops digging. And the guy below kept digging and eventually got to the diamonds. So the way I look at it is whenever I screw up or do something really, really stupid, I always think about that one really stupid thing is one step closer to figuring it out. So the most important thing you can do is take your losses and learn. And you have to remind yourself, what are you improving on and learning? But it's a journey and you just have to keep studying and eventually you get there. Okay, question. I make good money for a few days and then it is all wiped out in one day, like today. I gave back all what I earned in 2 weeks. We have definitely all been there and I know the feeling and that feeling sucks. But what I would say is there's two things. One is you're probably trading well in trading range days. What that means is you are probably fading breakouts. So you're buying below bars, scaling in lower, scalping out, buying closes, scalping out, buying below here, scalping out, selling above here, scaling in, scalping out. But then you start buying below bars and then you get trapped and you get killed. And if you get killed on days like today, it's usually due to not the unwillingness to exit a trade. So that is what I would focus on is, I'd also go back to, I'm going to just share this. It's going to take me a second. So I'm looking something up as I'm talking. I'm going to make this session a little bit longer. So I appreciate those that have decided to stay on. So I'm saving this document right now and I'm going to share it. And by share it, I mean I'm going to share my screen. So let's do this. I'm going to turn this off and I'm going to, this is a basic flow chart. And what's important is, I know it's hard to read. Whoops, maybe I can, here we go. But this is a flow chart, and I make these to try and practice binary decisions. First one you're going to recognize, is it a trend or a trading range? If it's a trade range, is it tight or broad? If it's tight, wait for the breakout because you cannot trade in a tight trading range. Do you have a breakout? No, wait for the breakout. And it's trying to practice, a form of systematic thinking. It's like practicing a layup over and over. You don't have to think about it when you're playing basketball. Is it broad? Are you in the middle of the trading range? No. Are you in the upper third of the trading range? Or the bottom third? You're in the bottom third. And you get the point. So it's just basic ways. If you're in the middle of a trading range, has price moved to the top or bottom of the range? No. Same question. If you're in a trend, is it in a breakout or a channel? If it's in a breakout, is it strong or weak? If it's strong, enter in the direction of the breakout for any reason. If it's weak, look to enter a pullback of the breakout. And I haven't finished this. It's just one example. Channel, is it tight or broad? If it's tight, only trade in the direction of the channel. If it's broad, trade it like a trading range that's sloped. So all that can be found in the video course or Al's books. So I would focus on always in trading. If I suspect you're probably fading breakouts and you're betting against tight channels and that's what's, you're picking bottoms. So you're buying bars like 48, 45, all of these, and repeatedly and taking big chunks of losses, or you're buying and holding. But I would focus on understanding what tight channels are and their breakouts on higher time frames. And the other thing is, when you see a breakout bar against you, just get out and look to re-enter. But I wouldn't sweat it. I mean, as long as you're learning, you can't take too big of losses, but as long as you're learning, then that's what matters. Are you looking for patterns to trade on the open? Question mark. Yes, I am looking for patterns on the open. Follow-up question. What patterns do you find best for beginners? Today we broke relatively large 18 bar range on the upside and downside, which confused me. Yeah, so today was one of those days where what this person's referring to is the bar 18 rule. Typically, by bar 18, when you break out of the bar 18 range, so here's the range high of 1, bar 18. When you break out above 1 or 12, it's going to typically lead to the high or low of the day. So we broke above bar 1, which means 12 should be the low of the day. Go back to my morning blog update, and I said somewhere in here, even though I wrote it kind of later than I should have, what I said was bar 12 is probably going to be the low of the day, and it should have been the low of the day. And we know that because we got a strong sell-off from the high of 33 to the low of 48 all the way down to here. This was low probability. So what I look for in the open is a few things. It's exactly what I talk about in the blog. Wait for the first 6 bars to 12 bars, 6 to 12 bars, because normally the first 6 bars lead to sideways trading. The second thing is to look for the opening swing. It's common to get an opening swing from a double bottom or a double top or a wedge bottom or a wedge top, or wait for a strong breakout with follow through. The other thing I always look at the prior day, the highs of yesterday and the low of yesterday. The range was so big yesterday that I started with the low of the day, 79, and the high of 81, just because that covered a lot of bars in the day. Some people say do the opposite of what conventional wisdom says, and eventually you make money in the market. I tried both and it's more confusing. Yeah, what they're saying is most breakouts fail, and most of the time, limit order traders make money. So buying below a bar and selling above a bar typically is more profitable. And that's true. I mean, the reality is most time the market goes sideways. The downside of that logic is if you buy below one, you sell the close at two, you buy the close at two, you sell above four, you buy below five, you buy more below three, you sell above seven, you will rack up a lot of money in 7 bars. If you do that on a 2-minute chart, you're going to make even more money. But what do you do when you see nine? If you sell above seven, you're probably going to buy below six or buy below seven. And what traders do is they buy more, and then they get whipsawed on 9 and 10, and they can't exit fast enough. So what they do, they basically end up they make 10, they make 5 or 6 or 7 really good trades, and they wipe it all out in 1 bar. So you have to understand breakouts and second legs, and I'm going to be talking more about that. And so study the videos. I hope to make more live streams and discuss more of that. It's talked about in the trading room more. So you just have to really think about breakouts and breakouts leading to second legs. Question: I keep hearing Al recommend swing trades over scalps, at least for rallies, but how would you know what will end up being a swing trade as it happens? That's the problem. What Al is saying is, I know people think Al is being hypocritical because he recommends swing trading, but he seems to never swing trade. And there's a reason for that. Al can read the probabilities really well, so he can scalp. He can aggressively rack up a lot of 2-point trades. And the reality is, he won't admit it, but he probably trades a lot of 1-minute charts and 2-minute charts more than he trades a 5-minute chart, if I had to guess. And the reason for that is it just makes sense. If I'm really good at reading price action, why would I trade a monthly chart? I'm going to trade a 5-minute chart. If I'm really good at trading a 5-minute chart and I really want to do well in a short period of time, why wouldn't I just trade a 1-minute chart or a 2-minute chart? If I trade a 2-minute chart compared to a 5-minute chart, I should get at least twice as many signals. I'm not, again, at all recommending anyone do that, because if you're not careful, you will lose money, and you're going to lose twice as much money as you would on a 5-minute chart. The reason Al recommends swing trading is because most traders cannot accurately label probabilities, and if they can label probabilities correctly, they can't do it for the whole day. So that is why, if you're swing trading and you're 40% right, then if you can just get twice your risk, you're in a spot to be consistently profitable. If you're scalping, going for 1 times your risk, you have to be often more than 60% accurate. You have to be more than 60% accurate to make money. If you're going for less than 1 times your risk, you've got to be a lot more than 60% accurate. So if you're talking about Al world, which is scalping, 60% is losing money. So a scalper's expectation is 70% profitable is okay. It's not great. That's just the truth behind trading. That's why most traders should swing trade. If you are scalping and you can't be regularly above 70%, then I would question how profitable that strategy is. How do I get access to Al's recordings? I'll just type in the website. So go to the bottom of the comments. Go to that website. If I spelt it wrong, I don't think I did, but it just disappeared. So go to that website. You gotta create a profile on the brookspriceaction.com website, and you go to forms, and you should be able to click on the trading room and get access to the trading room or the recordings. If you want the video course, just Google Brooks Trading Course or click on the About in this video and it's there. The record the recordings of Al Al doesn't do so much live trading, but I'm talking about the recordings of him talking in the trading room, and that's on the brookspriceaction.com website. Do you punish yourself if you don't follow your plan? I don't know. I mean, I think it depends on personality. I think it warrants if you're trying to be more disciplined, then maybe you don't let yourself trade for a day or two. But I don't know. I think in trading's really hard, and you have to be your biggest ally when it comes to trading. So for me, I really believe that you've got to you've got to bet on yourself and, be your number one cheerleader, as Al says, with trading. There's an Ask Al video over that. How do you beat or catch up with experience as a beginner? You just have to study. And this person below says more study is more confusing and exhausting. Well, here's the reality behind trading. You are in essence being a professional trader is like playing in the NFL or the NBA for major league sports people out there. And you're trying, or as Al would say, it's like becoming a doctor, he said. And when you become a doctor, you get out of medical school, he said, and you become a doctor, you're on day one and you have to do your whole residency. And then you have several years after you become a doctor to be great at it. Or you could say the same thing with grad school. You go to college, you get out of grad school. That's 6 years later. And then it takes quite a number of years being in your field to become really good at it. So back to the NBA analogy, Kobe Bryant went to the NBA when he was 18, skipped college. And year one, he sucked in the NBA. And he did better in the second year and then became a superstar several years later. So, you're trying to become a superstar in a sport. To me, trading is a sport, and you have to have that kind of mentality, which means you have to take care of yourself mentally and physically and, eat healthy. You've got to, pretend like you are a professional athlete trying to become great at a sport. And the reality is, it's just the truth. People are out to take your money. And yes, Al says that institutions are fighting over institutions, and that's true. Institutions don't care about retail traders. But what I'm saying is you have to treat it like there is someone trying to take your spot in the trading world, which means you have to study. As Al says, trading is a lot of work, and if you're not willing to do the work, you're not going to make it. It's just the truth. Now, the benefit to everybody in this room, including myself, is we all have access to Al. So instead of having to figure it out on your own, all you really have to do, the way I look at this is I just have to study what Al has told me to study. He's given me a book. He's given me a video course. I just have to study it. I don't have to figure it out. All I've got to do is study it until I learn it. It's actually but it's the best thing when you think about it. When you're starting a business, no one's giving you the business model. You have to figure everything out. Here in this example, you have more than 100 hours of a video course. You just have to learn it. And you're getting the benefit of learning 30 years of what Al has learned. So for me, the way I look at it is I've studied Al for 10 years. Al is 30 years plus into the trading game. If I'm 10 years into this journey, how fat, maybe I can catch, is it possible I can catch up to Al in 20 years? And I'm not saying that I'd ever catch up to Al. The point is, the benefit everyone has in this room is you don't have to spend the grueling years trying to learn what to study. Is bar 49 a good short? Um, I talked about that. It's testing the break-even price 35 and 38, so traders sold it. It's also it's a bull bar in a tight bull channel and a tight bear channel, so traders sold. I tend to do okay when I'm trading really small, but I get frustrated by low amounts. Then I scale up and lose discipline and get destroyed. Do you have any advice? Yeah, keep trading small. Keep trading small and increase in small increments, and you'll get there. The trading small is your benefit, though. So, question, being a beginner plus with an account size as low as $100, which strategy suits me? Trade Forex. You're trying to learn how to trade. You're not trying to become the richest person in the world on day one. Day one, you were trying to just be good at trading. All right, we're reading through more of these questions. I tried to buy with a limit order at what I thought was a pullback, and it ended up being an endless one. What do you recommend stop trying to take one side? Yeah, so they probably bought in this area, and instead of it reversing, they got whipsawed on the way down. And the reason for that is what I talked about. When you get a tight channel, you have to understand what tight channels look like. And they look like this. So I'm pulling up a chart. So here is an example of a tight channel. I think I did the wrong thing. Tight channel. See the sell off? It's not getting any closes above the moving average. 30-minute chart, it's only bear bars. Guess what a 60-minute chart's going to look like? Strong bear bars. You have to get to the point where you can see today this sell off, where you can see it like this. So how do you do that? You have to get comfortable with seeing this for what it is. 15-minute chart, strong sell off. 60-minute chart, strong sell off, pullback, second leg down. So I hope that answers your question. Uh, so question, they said these have been really informative videos. Do you always try to answer questions like this? I have a little bit more time today, so I'm trying to answer more questions. I typically will not answer this many questions at the end of the day just because I've really got other things I've got to get done when the market closes. When I'm in the trading room, I try and answer more questions throughout the day. So I will just periodically, when someone tags a question to me in the GoToWebinar, I'll periodically answer the question. And the other presenters in the room typically do the same thing. That's more easier to do because it's not, a lot of questions all at the end of the day. Okay, it looks like I'm going to give it, like I said, I've got a few more minutes. I'm going to give maybe 60 more seconds to see if anyone's got any final questions they want to ask before I end the stream. I've got a list from prior videos over trading topics, and I am planning to kind of do a Q&A session. maybe tomorrow or over the weekend, but I'll share it. Subscribe, just subscribe and do the notif and just turn on the notifications for the Brooks Trading course, and you'll see it pop up. If you're in the Discord channel, then I'll make an announcement on it when I do the live stream. Question, since every time frame is context dependent, what should I focus on? Focus on learning context. Here's the way I look at the market. I am so small in the market that I'm irrelevant. Therefore, I need to think like an institution. I need to be an institution. And what I mean by that is I need to think about this. So here is my chart. Actually, let's just make this more easy. Here's what I need to do. I need to figure out see all these charts? What time frame is this? You can see it in the bottom right corner, but when you go to Al's encyclopedia, start looking at charts and you won't see the time frame, and focus on the context. Strong rally, lots of bull bars. It's one bar on a higher time frame. So I'm always trying to compare context with each other. Strong bull bar, trading range, 3 pushes up, fair breakout, but you always have to wonder if it's going to be a higher low in a bull trend. And it was in this case. It was the opposite of what we had yesterday, which happened here. Strong rally, big bear bar. And that just, which you can't see it. It was the opposite of yesterday, which was here. Strong rally, bear bar. But that just takes time. You know, the longer you focus on trading, the easier it gets. What are your views on Anton Creel? Who do you study? I don't know who Anton Creel is, to be honest. There's really only 2 people I study with trading, and that is Al Brooks and Ali Afshari, which most of y'all know from the Brooks Trading course. And they both have very similar trading styles. And, you know, the reality is just study the video course, study everything Al has, and you're going to be fine. Can you quickly just give your best advice for traders currently learning Al's course? Yeah, it is not, you're not going to learn it all in one day. You're not going to learn it in a year. You're not going to learn it in a month. Enjoy the time studying. You have to look at it, you know, it's nothing. I'm just repeating what Al says. You have to look at this like a career, not like a, you know, I'm going to get rich in 1 year. You have to study. You've got to study charts. You've got to look at examples. You've got to do all sorts of various things. And what you can do on day 1 is when this video ends, you can go to the Brooks Trading course. If you don't have the video course, you can get the video course. I think there's like a 60-day money back guarantee, which is pretty long for, you know, a 100-hour video course. But you can go to the video course and just start watching some videos. If you have Al's book, pick up Al's book and start reading a chapter. What I would start with is the video course, get a good grasp on it, and then start learning. The key is to study. The worst thing you can do is sit on your hands and wonder what to do for hours on end and then never study. Is bar 11 a reasonable sell? Yeah, it's okay, but it's a sell climax after a tight a trading range in here. 50% of the time on the open, you get a major reversal from the initial move. So we have a sell-off, 50% chance we get a major reversal. Here, I thought it was a little bit higher because we had consecutive sell climaxes yesterday, and today was likely to be a trading range for at least a couple hours. Trading range for a couple hours, that is in Trading the Open videos. What's the best time frame for trading options? I think you have to take more swing trades on options, but if you're trading something like the SPY, you can trade options on a 5-minute chart. You could trade weekly options on the SPY on the 5-minute chart. But I would just focus on, you know, most traders, if they can afford it, I would focus on trading something like the SPY or the QQQ, which is the NASDAQ, and trade shares, trade really small. Have studied video course. What else do I have to continue? Well, 1-2 Tech, who asked the question, you said have studied the video course, but you didn't say I've studied the video course 20 times. So what I would tell you is to continue studying the video course. What is a second leg trap? Cloud. That is a question that is answered in the video course. It's answered actually quite a bit. So, rather than me answer what a second leg trap is, second leg trap traps traders into doing the wrong thing. This bar 12 is a second leg trap. Sold off, second sell off. Instead of forming a bear trend, it formed a trading range and trapped traders. That's all I'm going to say about it because it's in the video course. And the reality is you have to study the video course. 1-2 Tech says, I've studied the video course. Do I have to rewatch all of them? Well, I can't answer that for you. If you're satisfied with your trading abilities, then you have, I guess, completed your trading education. If you're not satisfied with your trading abilities, then you should probably watch more of the video course. That's really the secret behind all this is you just have to study. I mean, it's not the process is not that hard. The process is hard, but it's really not that difficult. I mean, you know what you have to do. The difficult part's doing it, but knowing what you have to do is really pretty simple. Okay, it looks like that is it for questions, and we're about an hour and 52 minutes into this. So thank you all for sticking around. And I would, again, if you don't have the Discord, I would go to that because that's the easiest way for me to announce when I'm going to do more live stream video courses. And, I was reading a question. I'm going to do more live stream videos like this with longer Q&As. So go to the Discord and go to the Brooks Trading course and just dig around and you'll find the Discord page. Sign up. It's free. And then you can pay more. It's easier to find announcements when there's going to be videos, or just subscribe to this YouTube channel and turn on the notifications, even though every YouTube person always says that, and I hate it. But that's the easiest way to see when videos are going to come out as well. Okay. I hope everyone has a good rest of their day, and thanks for sticking around. Y'all have a good one.